Welcome to the Daily Fiscal Pulse. We're looking at Tuesday, the 23rd of June, 2026. What you're about to hear covers settled data from that session, not real-time figures, so keep that context in mind. Let's start with what's capturing market attention right now. The AI and technology space is dominating conversation. You're seeing headlines like Qualcomm stock pops 15% after chipmaker almost doubles projection for 2029 non-handset revenue. And that narrative is clearly influencing trade direction. Of course, narratives can shift quickly. The actual flows tend to be more revealing about what's really happening underneath. Looking at the fiscal numbers, the net transfer came in at $5.7 billion. That's a reasonably stable number on its surface. What's more significant though is the shift we're seeing in shorter-term momentum. The 5-day average has dropped to roughly half of what we've observed in recent weeks. Tariff collections are doing the heavy lifting here, contributing $17.3 billion to that total. Price action is reflecting exactly what we're seeing in the flows. The ES closed at 7,435, which sits well beneath the 20-day moving average of 7,501. Over the past 20 days, we're looking at a 385-point range that's been grinding lower. So price and flows are essentially telling the same story. The daily picture is just one piece though. The longer-term direction is what really signals the underlying conditions. Government spending averaged about $2.1 billion per day over the past 5 days. Step that back to the 20-day picture and you're looking at roughly $3.2 billion per day. That's a meaningful deceleration. What this means is less cash is being injected into the system, flowing through households and making its way to financial markets. That tightens financial conditions. The year-over-year data reinforces that point. Fiscal year-to-date spending sits at $1,012.0 billion, running about 7% below where we were at this time last year. That's a material decline in fiscal support entering the system. From a market positioning angle, the fiscal backdrop isn't clearly favoring bulls or bears right now. Our conditions index is at -32, but history offers some perspective here. We've seen similar setups multiple times, and despite lighter liquidity, the S&P has still managed to average around plus 1.6% over the following month. Liquidity doesn't always dictate market direction in real time. Markets can push higher regardless. What we should be watching is positioning itself. Leveraged funds have been cutting back exposure while margin debt is sitting at the 100th percentile, which is quite elevated. Historically, readings this high tend to function as a caution flag rather than a bullish signal. So what does this setup mean for how markets actually move? With fiscal flows below year-ago levels, there's less of a financial cushion absorbing shocks. During periods of supportive news, equities can still work higher without issue. But when risk events emerge, like a potential escalation in AI or tech, declines can accelerate more sharply because there isn't as much liquidity sitting underneath ready to catch the fall. Looking ahead, there's one event that could materially shift the near-term flow picture. The 24th of June brings the SSA payment cycle. It's the fourth Wednesday of the month, and these payments can have a measurable effect on short-term flows. So fiscal drag is definitely visible in the data we're tracking. What we may be seeing is the pace of that tightening beginning to stabilize. The next significant move probably hinges on how these scheduled payments actually flow through the system. That's the landscape going into tomorrow's session.